Have you ever wondered what interest rates are? Let's imagine you're running a wildly successful lemonade stand. It's a hot day and business is booming. But then you get an idea. You could serve even more customers with a bigger stand and more lemons. You need more lemons and a bigger table. There's just one problem. You don't have enough money to make these improvements. Now let's say your neighbor, who also has a lemonade stand, offers to help. They agree to lend you $10, but they want you to pay back $11. Why the extra dollar? That's their way of saying, thanks for letting me lend you money. That extra dollar is what we call interest. And the agreement you've made with your neighbor? That's based on an interest rate. So, in your lemonade stand scenario, if you borrow $10, you pay back $11. The interest rate is what decides how much extra you pay back on top of what you borrowed. The extra dollar one is like interest, and the deal you made is based on an interest rate. In this case, if you borrow $10, you pay back $11. Let's delve a little further into this concept using our lemonade stand example. It's the rule that decides how much extra you need to pay back on top of what you borrowed. It's like a small thank you for the privilege of borrowing money. Now, this isn't just something that happens with lemonade stands. It's the same principle that banks operate on too. When people put their money in a bank, the bank might use that money to help other people, maybe someone who wants to buy a house or start their own business. Now, the bank can't just take that money without saying thank you. So, they pay a little bit of extra money to the people who put their money in the bank. This extra money is also called interest. On the other hand, when people borrow money from a bank, they are expected to pay back more than they borrowed. This extra money is their way of saying thank you to the bank for lending them the money. Interest rates help everyone know how much extra they need to give or get when dealing with money. So, interest rates are like the rules of borrowing and lending money. Just like in our lemonade stand example, these rules help us understand how much extra we'll need to give or receive when money is involved. Let's think about this in a broader context. When it comes to the world of finance, interest rates play a crucial role. They are the driving force behind most financial decisions. When interest rates are low, it's cheaper to borrow money. This can lead to more people buying houses, starting businesses, or even expanding their lemonade stands. On the other hand, when interest rates are high, saving money becomes more attractive because you'll receive more interest from the bank. Interest rates also serve as a tool for central banks to control inflation, which is the rate at which the prices of goods and services increase. If prices rise too quickly, central banks may increase interest rates to slow down spending and bring inflation under control. But remember, just like the lemonade stand, it's all about balance. Too high an interest rate, and it becomes difficult for people and businesses to borrow and grow. Too low, and it might not be worth saving your money in the bank. So, in conclusion, interest rates are more than just numbers. They are a fundamental aspect of our financial system, guiding our decisions on spending, saving, and investing. Whether it's for a lemonade stand or a big bank, interest rates make sure everyone knows what to expect when dealing with money.